So my name's Kirston Winters. I head product management for MarketServe, which is the derivative processing arm of IHS Markit. I'm delighted to be with you here today in Brussels to talk about the future of European financial market infrastructure. I'm going to start by giving a brief overview of IHS Markit, as some of you will be unaware of the company, and after which I'll give you a brief summary of the role we play in the OTC derivatives market, specifically as it relates to financial markets infrastructure. I'll finish by highlighting a few areas I think which will impact financial market infrastructure going forward, some of the current issues and possible opportunities to address those, and obviously we'll take those on further in the panel discussion. See if I can get this to work. Oh. No, that doesn't seem to have worked. Seems to be having a technical... Right, we're good. So we're ultimately an information company. We have expertise across the critical industries worldwide, including both the real economy and financial services. The key sectors we cover are shown on screen, and we leverage technology and data science to provide data, insights, and software solutions to enable our customers to make better informed decisions, driving growth, performance, and efficiency. We're UK headquartered, but we have 27 offices across 13 countries across Europe. We have over 15,000 colleagues globally, of whom over 5,000 are analysts and subject matter experts. We have an extremely broad customer base spread across major industries, and in the financial services we service all investment banks globally, the top 50 hedge funds, the top 50 asset managers, as well as all G20 governments. We really are having trouble with these slides. Right. Specifically on financial services, we have over 70 products and services covering everything from pricing and valuation services to benchmarks and securities lending data. In terms of MarketServe itself, we support the key post-trade processing workflows across the industry, including electronic confirmation, clearing, allocation and reporting, which is a hot topic always in Europe, as well as trading venue connectivity across 4 of the 5 OTC asset classes, so interest rates, credit derivatives, equity derivatives and the FX markets. Our unique position as a third-party provider gives us a unique insight and perspective, because we're not a trading venue, we're not a CCP, we're not a trade repository, we're not a bank. We're a service provider plumbing together the market, which gives us that unique perspective. Our network includes all major OTC trading venues, 15 CCPs globally, and over 2,500 clients representing 35,000 legal entities. Our services and network enables us to future-proof the global post-trade processing for OTC derivatives by enabling firms to use the same workflow regardless of their choice of trading venue, regardless of their choice of CCP, and regardless of their choice of trade repository. This is critical because as markets shift and people change the way they're doing things due to market dynamics, people can use the same post-trade processing workflow regardless of where they choose to trade or who they choose to trade with. In Europe, we cover post-trade services, including MiFID and EMIR. In terms of EMIR, specifically the electronic confirmation, the clearing connectivity, and also the trade reporting that is required under European rules. So, turning to the topic of the day, the European financial market infrastructure, what are the current challenges and what are the potential opportunities we have? Well, as said in the opening remarks, 10 years of change, 10 years of regulation, what have we got? Well, we've certainly got a lot more regulation. We've certainly got a lot more data being reported. More data collection than ever before, more data reporting than ever before. There's definitely been an increase in clearing. There was a lot of clearing before the regulation, but there's definitely been an increase there. And there's definitely been an increase in capital held and margin. And, I think we will probably spend the next hour and a half arguing over the details of what works well and what doesn't. But ultimately, no one can disagree that there's been overall a lot of improvements, both in terms of transparency and less systemic risk. However, there's always room for improvement, and there are opportunities to improve the rules through initiatives like the MiFID II review, things like the fitness check that was started last year, and by applying proportionality to existing legislation. A couple of examples of proportionality I'll raise are, one is around small firms being exempt, firms who do not have huge budgets to be compliant and do not pose any sort of systemic risk, but ultimately have to meet the same high standards of reporting and other things. And some of that has been addressed, e.g. EMIR refit, but there's certainly other areas where we can exempt smaller firms more. And secondly, specific rules requiring 100% compliance. My favourite topic, the STP requirements, where, in principle, sending trades to clearing quickly is a good thing, but having to do 100% of them within 10 seconds, clearly people are going to be non-compliant. So I think going forward, there's definitely changes that can be made, but I think it's about addressing pinch points, not completely overhauling regulation. Turning to my second point and third points, the lack of harmonisation globally has definitely increased costs and led to poor data quality. Firms have limited budgets, and the more data they have to report across more fields will lead inevitably to poorer data quality. And I recognise that perfect harmonisation across regimes globally is not going to happen. But Europe must continue to lead internationally and push for better harmonisation on data requirements wherever possible and wherever practical, and allow things like equivalence and substitute compliance on market-specific requirements where it makes sense to do so. It's important to note that financial markets, and in particular OTC derivatives, rapidly evolve and adapt. Fragmentation of liquidity across markets has occurred globally, and we do worry that Brexit will drive further fragmentation, increasing the cost of compliance and further reducing liquidity and data quality, and potentially increasing capital and margin requirements for EU and non-EU firms. There's also other headwinds coming, things like IBOR reform, which is a huge initiative and involves replacing OTC derivatives, loans and other contracts referencing LIBOR with new contracts referencing risk-free rates or possibly term risk-free rates. And this certainly has the potential to disrupt markets and liquidity, and we've been working hard with our customers to support all the new indexes and ensure that they can manage their legacy positions, but inevitably such a large change will lead to some disruption and will need the appropriate regulatory focus and proportionate timelines to enable, particularly again, smaller firms to make that migration. A couple of final points before I close. RegTech, there's a lot of noise in the market on fintech for the last number of years, and certainly RegTech as well. And there's no doubt that technology such as ours can help solve for fragmentation, improve data quality and reduce costs. And the adoption of newer technologies can drive better, faster and cheaper compliance and automated compliance. For example, we recently replaced a legacy platform, actually last year, with a new modern platform based on platform as a service, so PaaS technology, using microservices on cloud infrastructure. And that definitely delivers higher levels of flexibility, customization, high throughput and availability. And I think all firms are trying to move and adopt modern technologies. But the biggest challenge, I think, with adoption of technology in general and service providers, and with RegTech in particular, is regulation. I think there's a few areas we need to consider. So one is outsourcing, and making sure that the outsourcing rules are proportionate so that firms are able to outsource services to third-party providers. And particularly for critical market infrastructure providers, if regulation is introduced, we need to ensure that that's proportionate and doesn't make it harder for firms to adopt. We also need to ensure a level playing field between larger firms and smaller firms to give all the equal opportunity to compete. We're also keen on the fact that added value services are not regulated. An unregulated activity that is a value-added service isn't regulated just because a firm is regulated. And finally, we need to avoid driving up unnecessary costs on third-party providers, either directly or indirectly through not allowing, making it harder for a firm to use a third party than it would be to comply for themselves. So I think, there's areas in terms of RegTech and the adoption of technology, where appropriate regulation can help foster the use of RegTech and encourage its use across the industry, which ultimately will have benefits to the firms in terms of reduced costs, efficiency, but also in terms of the regulators and the industry in general through better data quality. So with that, I'll draw to a close. Thank you for your time and look forward to the discussion.